So hello and welcome everybody to UC San Diego Rady School of Management's online masterclass series brought to you by the MBA admissions team. Today's masterclass is called Political Partisanship and the Stock Market, Evidence from COVID-19 with Professor William Mullins. Now, before we get started, I'd like to share some basic information with each of you. Today's class is scheduled to last up to about 45 minutes or so. Questions can be submitted into the chat at any time. As your moderator, I might be able to answer the question immediately, or perhaps during the presentation. Professor Mullins will also have access to the chat, so if there's a question that comes up while he's presenting, he may be able to see that. Either way, we'll be on hand on the backside to help answer questions as we go through. And at any point, if you want to schedule a personal advising session for the full-time MBA program, you'll email me directly at jnemeth@ucsd.edu. And for all other programs, please email radygradadmissions@ucsd.edu. As I said, my name is Julia Nemeth, the Assistant Director of Graduate Admissions and Recruitment here at the Rady School with a focus on the full-time MBA program. I've been with Rady since 2014, and it's been one of my goals to collaborate with faculty and to present a masterclass series like this for prospective MBA students ever since I started recruiting. I'm excited to be here today. And of course, if you have any questions, well, there's my email again. Now, before Professor Mullins joins us, I would like to take a moment to share with you the Rady School's mission, which is at the heart of everything we do. Now, here at the Rady School, it is our mission to develop ethical and entrepreneurial leaders who make a positive impact in the world through innovation, collaboration, and knowledge. The Rady School students, alumni, and faculty over the last 17 years have developed over 180 companies benefiting and impacting the innovation economy of our region, state, country, and world. And with only our second dean at the helm, Dean Lisa Ordonez intends to transition the school from a startup to focus on growth and further cement the school's global business research prominence and impact as an innovation-focused economic engine within the San Diego business community and beyond. The Rady School's graduate programs cover a range of disciplines, from the flagship MBA to our specialized programs in business analytics, professional accountancy, Masters of Finance, and even a PhD program. Of these, we also offer the MBA in a flexible format, perfect for working professionals, and have just added the Flex Weekend option for the MS Business Analytics as well. The school also has a series of very popular undergraduate minors and 3 collaborative majors at UC San Diego. And now it is poll time. So I would like to well, unfortunately, my poll's not working today, but I wanted to get a feel for where people are from. So if you could, in the chat, just take a moment to share with me where in the world you're located. If you want to give me a city and a country name, that would be great. And let me know where you're all coming from. So I see the Eastern Seaboard, North Carolina. I see India and Riverside. Hello. And Tokyo and Los Angeles. Wow. So all of our attendees here, Seattle, Washington, wow, they're from all corners of the world. And I think you're going to find that that is definitely something that is a part of the uniqueness of the Rady School of Management. We have a wide variety of students from a large grouping of nations. So thank you for sharing where you're coming from. I'm located in my home here in Temecula, California, just north of San Diego. Moving on, I wanted to share upcoming deadlines. Each of our programs are currently being reviewed on a rolling basis within the rounds listed here. The MBA programs, both flex and full-time, have a round 3 deadline of April 1st, which is also the final round for international applicants, as well as a round 4 deadline of May 1 for domestic applicants seeking merit-based fellowships. The specialized master's programs are all now in round 3 of admissions and will accept applications through April 1st. Again, the final deadline for international applicants to these programs, as well as their merit-based fellowship deadline. Future rounds and other deadlines will also be available and are posted on our website at rady.ucsd.edu. Now, really quickly, the graduate admissions process for those who haven't yet begun, it's quite simple, really. First, we always recommend connecting with a grad admissions advisor like myself to learn more about the program in which you're interested, to determine your preparedness and potential with the program itself. Secondly, you do have to complete the application checklist. Now, these are on our web pages and are covered in advising sessions regularly, so we can go through that on a one-on-one. The third step after you've submitted your application is to potentially receive a request for an interview. Now, this is highly program dependent. So for MBA programs, you should expect an invitation to interview if you've passed the initial committee review. So that's definitely a part of it for the MBA program. The fourth step would be, of course, to accept admission if it's offered and to submit your enrollment deposit. Now, this deposit holds your seat in the cohort and confirms your commitment to joining Rady at the start of your program. And number five, the fifth and final step is to get ready, or get Rady, as we like to say here at the Rady School of Management, for a transformative professional experience. I'd like to take a moment now to introduce our headliner for today. It is going to be Professor Will Mullins. And this is the reason that you're all here, taking the time to join us today, is to learn from esteemed Assistant Professor of Finance, Will Mullins. His research is in empirical banking, corporate finance, and behavioral finance. He's been published in the Journal of Financial Economics and the Review of Asset Pricing Studies, and he has written a teaching case for Harvard Business School. He received the Excellence in Teaching Awards here for the Master of Finance program at the Rady School in 2019 and in 2020, and a Distinguished Referee Award for Academic Reviewing from the Review of Finance in 2019. Prior to coming to Rady, he was an assistant professor at the R.H. Smith School of Business, University of Maryland, where he received distinguished teaching awards for the MBA in 2014, 15, and 2016. He has a PhD in financial economics from MIT's Sloan School of Management, a Master of Science in Economics from the Pontificia Universidad Católica de Chile, and a BA from the University of Oxford. He is from Chile, and before his PhD, he worked as an advisor to the Minister of Finance of Chile, Dr. Andres Velasco. So walking over, I'm going to double check and make sure that he has arrived. He may not have logged in just yet. He was invited to join us just a few minutes after we got started. Let me see real quick, see if he's here. If not, that's okay, because what I can do is I can close my slides and invite everyone to join me so I can see all of your faces. Oh, he is here. Oh, thank you. Fantastic. There's Professor William Mullins. I'd like to now invite you to please join us here. I know that our videographer over from the marketing team is here to assist us as well. So he'll be able to make sure that Professor Mullins has access to his there we go, has access to share his screen instead of me sharing my screen. So Professor Mullins, thank you so much for joining us. I hope that introduction was fair. And I'm going to get off camera and off mic so that you can take over and lead us through this fantastic presentation.
Great. Thank you, Julia. Can I just confirm that you can hear me?
I sure can. I think everybody else can too, hopefully. Let's get thumbs up from folks if we can do reactions.
Great. I could be mistaken, but I had this down on my calendar as starting in 5 more minutes. Is that correct? Or
yeah, so we were doing some introductory pieces here and wanted to definitely highlight you. If you're ready to go, we can get started. If not, I can always talk more about admissions.
Oh, I can definitely wait. I was just wondering if we would get more attendance if we waited until the kind of the official time.
People do come and go. And so when we invited guests, we always invite them directly about, 10, 15 minutes before you're set to start your presentation. So everyone who's here is here at this point. We can definitely reach out and chit chat a little bit more if you'd like to talk more about your background and a little bit more about your research before you get started.
Sure. So I'm very happy to do this. So I've been at the radio school now for 3 years, and before I think vaguely you probably know this, but I'm a financial economist, and I used to work for the Minister of Finance of Chile before I did my PhD. And I'm doing some research on a theme which is what I'm talking about today, which is about investor beliefs and how we can use social media to extract underlying investor beliefs. And it's very topical because one of the papers I'm going to be talking about is the partisan effects or the political effects of these on financial markets. And another paper that I'm going to talk about maybe less extensively is about how kind of some behavioral biases can be extracted from the social media environment. So it's kind of a theme that I'm working on, and I've got a couple of other projects going with political themes and how they affect different pieces of the economy. So it's kind of topical. Luckily, I think it's become topical. So I'm happy to get going with the presentation, unless anyone has any questions before I start. Okay, so. So today I'm going to talk about two academic papers of mine, and they're both written with the same pair of co-authors, Tony Cookson, who's at the University of Colorado Boulder, and Joey Engelberg. He's also a professor here at Rady, a finance professor here at Rady. And the first of these is Does Partisanship Shape Investment Beliefs? Evidence from the COVID-19 Pandemic, and that's already been published in the Review of Asset Pricing Studies in an academic journal. And then the second paper with these co-authors is about echo chambers in financial markets, and it's under review for academic publication. So these two papers connect, as you'll see, pretty nicely. Just finally, to before I get into the details, I just want to confirm with Julia what the timing of this is. So I have it also down as about half an hour. Mm-hmm. And is that correct, or is that too long?
No, we've got 30 minutes on the clock. I think we're very flexible. If you want to, spread it a little bit longer, you're welcome to do so. But we set it at about 30 minutes for presentation. And then if people have questions at the end, would love to field those as well if you have time.
Right. So yeah, I asked because talking about my own research, I could easily have you guys here for hours, and that's not my intention to bore you guys with too many details. But I do want to encourage people, if you want to just interrupt with questions. That might be easier. Although I'm not looking at the chat, so full disclosure, I'll just just chime in with questions if you have them. Okay. So this first paper is about partisanship, political partisanship in the US and how it's affecting investment beliefs. And we're looking at the COVID-19 pandemic. And why the COVID-19 pandemic? Because it's just a wonderful laboratory. I mean, it's a tragedy for all of us, and for many people, it's a very serious tragedy. But as an academic, it gives you a laboratory for looking at specific themes in financial markets, and that's what we're taking advantage of. So let me give you some background. So in the US, political polarization has increased substantially over the last 30 years. This is true in the news media. This is true in the speech of politicians. And this is kind of a nice measure from a paper by Genskow, Shapiro, and Taddy, which recently came out. You can see this pink line with the confidence intervals around it, just giving you an idea of the uncertainty. This is the average partisanship of US politicians and how federal politicians and how it's spiked since the early 1990s. It's really risen very dramatically. And I suspect, were we to extend this to the post-2015 period, because this goes to about 2013, it would be even higher. So, there are various measures of polarization. This one is just a great visual of it, but many measures are suggesting to us that polarization is an increasing force in the US. And even, you can go from those to macro things like, the speech of politicians or how polarized news media is. But you can also go to the micro. And there's this great paper by Chen and Royler, which shows that Thanksgiving, within families has become shorter and less likely to cross state lines when it's likely that people have fewer kind of less political alignment. So basically, the kind of the angry uncle, the proverbial angry uncle who wants to talk to you about politics used to be more tolerable to the average American, according to Chen and Royler, than he or she is today. And it's not just the political domain. There's this argument that we are now sorting to live among co-partisans more often than we used to be. So, Republicans living with Republicans, Democrats living with Democrats. That there is some debate as to whether this is true. What is definitely true is people say this. The question is whether they actually move. Do people really move to Canada, or just argue that they're going to move to Canada if they're Democrats and a Republican wins? There's also, a lot of examples about people being very unhappy about the idea of their child marrying someone of the opposite side. So, Democratic parents being very unhappy with their children marrying Republicans. That's definitely sort of increased over time, and vice versa. You can see it on dating websites. So, for example, on eHarmony, people didn't used to report their partisan affiliation, and after 2016, people started reporting it at a very much higher rate than they used to. And even in social distancing, there's a very large, in the COVID-19 pandemic, there's a very large component of political difference. So areas with greatest, pro-Republican leanings are less likely to take sort of social distancing and masks seriously, just because they have been politicized. This is obviously on average. Okay, so with this background, what we do is we say, well, these political and politicization forces, are they likely to matter in financial settings? And we would argue that probably not. Financial settings is a very strong incentive to get these things right. It's not an expressive domain, as politics is sometimes called, an area where you want to express your feelings, but rather it's an area in which you want to be right because your money is on the line. Okay. And so our key question in this academic research is, does partisanship affect investment beliefs? And we generally think that, whether we want to buy a share, some shares of, for example, Walmart or not, should depend on Walmart's cash flow. It's about whether we think Walmart is going to be, a great business to own or not, and not on our political identity. And our setting is obviously the COVID period. And what we're going to do is we're going to use information from the social network called StockTwits, which is, if you're not familiar with it, it's a kind of Twitter for stock investment and for other kind of financial investments. And what we're going to do is we're going to make use of people's tweets to identify them as Republicans or not Republicans based on their tweets before COVID happened. And I'll explain why we focus on Republicans, essentially because they're easier to identify. There are more of them on StockTwits. And then we look at how the COVID period has changes, how Republicans differ from other investors through the COVID period. And what do we find? Essentially that during the pandemic, partisan Republicans remain substantially more optimistic about the stock market, but become more pessimistic about Chinese stocks than everybody else. And that disagreement between Republicans and Democrats explains about 20% of a massive rise in stock market trading during COVID-19. And I'm going to put these findings in some context later, but essentially we would have expected none of this. This is all quite kind of shocking to us financial academics, because what it suggests is that people are bringing politics into their investing decisions in a way that they never did before. Okay. Now, what do we know? What does existing research tell us about this? Well, not much. There's one very nice paper by Mewis, Parker, Shaw, and Steinmester, where they look at differential reactions to the 2016 presidential election. Essentially, they look at whether people move their pension funds and take more or less risk, their pension investments, and they find that areas that have more Republicans tend to take more market risk. But what we're looking at is actually different. We're looking at the uncertainty that people face as a result of the COVID-19 pandemic. And we're looking at how that as a shock, that uncertainty, which is a pretty radical uncertainty. We don't know, how COVID is going to affect the economy, how it's going to affect our jobs, how it's going to affect politics. It's one of these real kind of shakeups of modern life. And we're showing how it drives partisans to their core identity in a way that hasn't been shown before. Now, existing research says, when people disagree about stock prices, there tend to be two categories in which they disagree. Either the idea that they have different models of the world, or they have different information. Those are the two ways which kind of drive disagreement. And by the way, the reason that financial economists care about disagreement is without disagreement, there's no trading. If, hi Alessia. So let's say, Alessia and I are both in the stock market. And if we agree about the price of the stock, we're not going to trade. There's no need for us to trade because we agree. But if I think it's going to go up and she thinks it's going to go down, then there's space for us to trade. So disagreement is necessary for trading to happen. Whenever someone is buying, somebody else is selling. Otherwise, no trade happens. And so, financial economists really have focused on understanding disagreement. And our finding pushes us towards the idea that models are what is driving disagreement and thus trading, much more than information. So, in this case, these are partisan models or political models being used in a financial setting. And finally, there is a burgeoning research literature on COVID-19 and also on the stock markets, because a lot has been happening over the last year and a bit, almost a year. But we are the first paper that really tried to connect the political realms with the financial realms using the COVID shock. Okay. So how are we going to measure this? So the big challenge for academic research is, it's fine to put this big game and give you these nice big picture ideas, but now the idea is to prove it or give us evidence that is very, very compelling. So what we're going to do is we're going to use stock tweets. And the nice thing about stock tweets is that users, when they post something about a stock, they self-declare as either being bullish or bearish about a symbol. So let's say, Tesla is the symbol that I'm writing about. There's a little slider, which I'll show you in a minute, which allows me to say, I can type, Tesla is going to be do fantastically well. And then I can click on this slider and tag the post as being bullish about Tesla. And that's very nice because it gives you a very explicit declaration of beliefs. Because without that, what people have had to do is to go into some text, essentially text reading algorithms that classify, whether people are bullish or not based on the tone of their words. And obviously, these are millions and millions of messages, and computers can really struggle to do this well. Here, we don't need to. There's no question that we're getting this accurately because people themselves are just clicking on a button, telling us if they're bullish or bearish about that symbol. And we focus on the period of March through April, because that's when we could get the data. So March 2019 to April 2020, we obviously have data from far before then, which we do use for some of our analyses. And the way we identify party is that we use people's tweets before COVID from 2013 to 2019 as a way of identifying strong Republican partisans. And if users make or like at least 3, clearly Republican messages, and I'm going to tell you about what I mean by how clearly Republican these are, then we can label them as Republicans. We also do this, by the way, with Democrats. It's just very, very hard to identify Democrats. There aren't that many of them that are easily identifiable compared to Republicans. And that might be because there are more Republicans that invest in the stock market. There is some evidence of this, but not in our paper. Or it might be that there are more Republicans that like to use stock tweets. We have a lot of users, but still, it could happen. Whatever the reason, the Republicans we can identify are going to be our main focus, and we're going to be comparing them to essentially everybody else. Okay. Now, the first question to think about is, well, is this stock tweets at all reliable? Can we believe anything that we find using this data? And there's a couple of reasons to think we might find something interesting. So the first reason is, users are not able to delete posts. So this is very important because people can't selectively edit their record. So if they said, Tesla was going to go up and it went down, they can't delete that. That's there forever, and we can see it. So they have a clear incentive to be right. And many of them post under their real name in an effort to build a reputation and to build following, and especially for financial professionals. And in addition, there have been a couple of papers, notably Cookson and Nietner, showing that stock tweets behaves, the information on stock tweets lines up pretty nicely with economic events that we would expect it to line up with. So it shows that sentiment spikes upwards, so it becomes more positive around positive earnings news. It shows that the sentiment of professionals does better than the sentiment of novices. So people without investment experience are less able to predict stock returns and movements of stocks. And that posting messages and sentiment correlates with trading at the stock day level. So already there is independent verification. It's not just Cookson and Nita, a couple of others, showing that StockTwits is a pretty good laboratory for testing out sentiment and its relationship to the market. Let me give you an example of a StockTwits post. So, you write something here in this text box, and then you move the slider to the left or to the right if you're a bull or a bear. And so, here's a user called Todd Sullivan, and he's saying, that TPL, which is the symbol, it's a symbol for a specific stock. He's bullish about it. He moved it into the bullish category. And so, we have every one of these posts on StockTwits, and we can, extract the text of it, extract the timing, the symbol, and the sentiment. Okay. Right now, how do we classify users? So, there are some details here, but essentially, we start with some keywords. We start with the hashtag MAGA 2020 keyword and the hashtag Trump 2020 keyword to identify Republican users. And within the set of Republican users that use those terms ever, we start to look for overused political terms. So terms that are evidently political and that they use frequently. And then we use those terms to expand the set of Republican users. And again, look at the phrases that stand out statistically in that set of Republican users, and so on, until we cannot identify new users based on this algorithm. And we do the same thing for Democrats. And so, any Republican users that make or like 3 more Republican messages than more Republican than Democrat messages, we classify as Republicans. And we can do this with 5, we can do this with 2, we can do this with more or fewer. It's just, this is an arbitrary number. Okay, now the keywords that we use are kind of quite rude. Many of them are, they're just very effective. So you can see, Obama as a Republican keyword, MAGA, Trump 2020, Trump hater, liberal agenda, Sleepy Joe. These are the kind of things that if people, write 3 different messages at 3 different points in time using these words, we're pretty confident that they're Republicans. And then similarly, a lot of the Democrat ones are even ruder and focused on Trump. And in the end, we just don't have enough Democrats for this to work. So we just focus on the Republicans to identify users that are Republicans. Okay, and here are some examples of partisan tweets. October 27, or let's say this one, July 8th. A user wrote, "I probably won't be alive to see it, but the U.S. is a short step to being a socialist country. Only 1 election away. Vote Trump 2020 or else." So people who say this, we're pretty confident that they are, publicly post this in a setting where they can't delete it. We're pretty confident they are Republicans. Okay, now first question: does this sentiment measure track notable events? So we start from when the beginning of our data is, where 2015. Actually, it's a bit earlier, but there's just not enough data in the preceding period. And this is just showing you sentiment on StockTwits. And it's actually kind of downward sloping on average. But partisan Republicans actually diverge around when Trump was nominated. You see the red line is the partisan Republicans, the black line is the baseline. And when Trump was elected, there's a bit of a spike in sentiment. This is when the US-China trade war begins, and that led to lower sentiment for non-Republicans, but not much of an effect for normal Republicans. And then again, the market drawdown of December 2018 led to a big drop in sentiment for most users, but not really for Republicans. And then COVID-19 saw a massive drop in sentiment for most users, but not for the subset of Republican users. So it does seem to track events that are very important within the market. Okay. Now, another way of checking whether this is just us focusing on StockTwits, but StockTwits doesn't matter, it doesn't connect with the rest of the world, is whether, Google, if we look at Google Trends, you can see that it also spikes when we expect it to spike. But, in the interest of time, let me go to some of the evidence, okay? So I'm going to present the main findings graphically to highlight the timing and the persistence of the effect. So here you can see, using daily data, you can see that basically the red line, which are partisan Republicans, and the baseline of everybody else, when I zoom into 2020, in January and February, everything basically tracked. They were very similar. Then when the US community spread hits, you see a massive decline in both the S&P 500, which is this blue line, and baseline sentiment of people on StockTwits. So people became about as pessimistic as the S&P 500. So they downgraded their beliefs about the profitability of the stock market in line with the S&P 500. By contrast, Republicans didn't. By contrast, the Republicans even became a little bit more optimistic on average than they were before. So there was a very sharp divergence happening around the time when it was confirmed that COVID was spreading in the US. Secondly, what we do is we look at this in a regression setting. We use some statistical techniques to line this up, and you can see that on average there wasn't any difference. Basically, the standard error bars include 0 until March 2020, when Republicans started becoming much more optimistic than everybody else. And you can see, there's about 4 percentage points more optimistic than everybody else starting in March. But before then, there was nothing. Okay, and then we ask the question: is this effect different for these groups of stocks, like Chinese stocks, recent losers, or large bellwether stocks? And this is going to give us evidence of a pattern that can only really be explained by partisan views. Okay, so firstly, what's the baseline difference between partisan Republicans and everybody else? It's a pretty low 2%. They're a little bit more optimistic, but not much. But they become very negative and pessimistic about Chinese stocks. And I'm not going to show you this, but this lines up with when President Trump started directly attacking China for, as alleging it was responsible for COVID-19. And you could see that, pessimism about Chinese stocks started to go up among Republicans compared to everybody else. On the other hand, stocks that had recently done poorly, partisan Republicans were much more optimistic about. And large bellwether stocks in the S&P 500 index of the largest firms in the economy on the stock market, they were also more optimistic. So essentially, Republicans were more optimistic about US companies, about big US companies and companies that had done poorly recently, and more pessimistic about Chinese stocks relative to everybody else. And this lines up, this isn't general optimism. This lines up with a political model in which, if President Trump is optimistic about the economy, and he was, and he would talk up the stock market, then, partisan Republicans were more optimistic than average StockTwits users. And if President Trump was negative about Chinese stocks, then partisan Republican investors were more negative about Chinese stocks than the average user. And you could see the time pattern for Chinese stocks. Basically, Republicans were not more pessimistic until February 2020, and then you can see kind of the pessimism here. They become much less optimistic, and this persists over time. I actually expanded this for this presentation outside of the initial sample period, so that for at least 6 months, 5 months afterwards, and this is at the weekly level, Republicans were much more pessimistic about Chinese stocks than every other user on StockTwits. Okay, now a big question is this all just about sentiment within StockTwits? Does it have any connection to the broader stock market, the New York Stock Exchange, to Amex, to real transactions, or is it just people just chatting online and having no connection to the real world? Well, in short, it did affect the stock market. So what we should, firstly, I want to show you that stock turnover, which is a measure of trading, spiked massively as a result of COVID. So this is the line of the first case of community spread, and just trading just spiked. People started trading way, way more than they had ever done before. And what we do is we just say, we generate a measure of partisan disagreement between Republicans and Democrats about each stock. And then we see whether partisan disagreement is driving daily stock turnover. And, what do we find? Well, the volume spike is about 36%. And how much of it is explained by increased attention, by people paying more attention to the market? About 20 points of that. But then the rest is unexplained by attention. So, roughly a third or a bit more, 40% is unexplained by the typical thing that we would expect to be driving volume, which is just people paying more attention to stocks because news is coming out about them. And typically, when we look at partisan disagreement between Republicans and Democrats outside of the COVID period, then you see it doesn't really explain trading very much. So partisan disagreement outside of the COVID period doesn't really matter to trading. But during COVID, you could see that actually it explains almost all of the part of the turnover that's unexplained by attention. So, disagreement during COVID and partisan disagreement during COVID make up essentially all of this amount. So what we're showing here is that a standard deviation increase in partisan disagreement, was driving about a third or slightly under a third of the spike in volume. So during COVID, unlike any time in the past, partisan disagreement became very, very important for trading. And so trading not on stock puts, trading on US stock exchanges. So we are able to predict and explain trading on US stock exchanges as a result of disagreement on stock twits between partisans. So you should think of stock twits, or at least we do, as a focus group that is reflecting underlying disagreement in the US population about political issues. And so that's why it's showing up in the broader stock market and not just on stock twits. So, before I go on to my next paper, which I'll do briefly because I know I only have 8 minutes, I just want to put these findings in context. So what are we looking at? We're looking during COVID, which is a period of pretty unprecedented levels of uncertainty. We see investors using their core political identity as a lens through which to take their investing decisions. Partisan disagreement lines up very closely with the politicization of the stock market. It drives trading, and it's part of this bigger picture linking politics and the economy, which is the whole theme that I'm working on right now. And nobody is going to be surprised that partisans disagree, but the fact that they disagree about stock investing, about which stocks to invest in, is a new fact and is perhaps an indication that this increasing polarization is entering new domains that it had previously not entered. Okay, so now in my remaining time, I want to tell you about another paper, which is a little bit newer. Although, the other one isn't exactly old. It was published last year, as you can see from the data, but this one is even newer. It was the original project, actually, just taken longer. And this also uses stock twits. With the same co-authors, Tony Cookson of University of Colorado Boulder and Joey Engelberg, also a finance professor at Rady. So here the idea is about echo chambers. So we're going to use a political analogy, but this one isn't actually political. This is us using stock twits to try and understand how investors form their beliefs. So just as before, the previous paper was about how investors' beliefs are affected by politics. Here, it's about how investors' beliefs are affected by a behavioral bias, which is the propensity to put oneself into an echo chamber. So let me just give you the thought experiment. Imagine like a population of Republicans who are, these little stick people in red, and Democrats, these little stick people in blue. The key question here is, do they choose to see the same information? Well, I think it's pretty fair to say that they don't. Yeah, that Republicans disproportionately watch Fox News and Democrats disproportionately watch MSNBC. Or I obviously I'm not American, but this is my impression. And it's not to say that there are no Democrats watching Fox, no Republicans watching MSNBC, but this is what we think of as an echo chamber, which means that people are choosing to obtain their information from a source that's likely to agree with their prior belief. So, if you start out as a Republican and you watch Fox News, you are less likely to be kind of incensed by misrepresentation in your eyes than if you watch MSNBC, and vice versa. So this is a pretty well-established perception that people have that are echo chambers in politics. And the question that we ask is, are there echo chambers in sentiment? Now, among investor sentiment, So now let's imagine that instead of Republicans and Democrats, we have people who are bullish about Tesla and people who are bearish about Tesla, people who think Tesla is going to do well and people who think Tesla is going to do poorly. The question here is, does everyone access information equally? And so, they're spread out as they are here. Or do we have echo chambers where all the bulls tend to focus on areas where they can receive bullish information, and all the bears focus on areas where they receive bearish information? And this is essentially what we find. Now, obviously, I'm going to show you some evidence for this, but this is the underlying thrust of our idea and our finding, which is, we use StockTwits as a laboratory to show that people are selecting, if they are previously declared as bullish, they're selecting into looking for bullish information, and people who are previously identified as bearish are selecting into finding bearish information, which is very surprising. So, it's in markets, it's different to politics. Politics, you might choose to ignore facts, in search of expressive views, because there isn't much downside to being wrong about politics, whatever it means to be wrong about politics. But in investing, it really does cost you money to be wrong about investing. So you should actually want to consume as much information as possible that's relevant to the value of the firm that you're investing in. So it doesn't really matter to me as an investor whether Walmart is, if Walmart is doing well or poorly. If I have a position in it, I just want as much information as possible. It doesn't matter if I have previously thought it's doing well. In other settings, in politics and beliefs about science, there are no immediate financial incentives to be correct. But in finance, where nobody has really been able to show echo chambers, it's not surprising. It's very costly to be in an echo chamber in a financial setting. So we look within StockTwits. I'm just going to go through this quickly. And what do we find? We find strong echo chambers effect. So people who describe themselves as bulls are 5 times more likely to subsequently follow a user with a bullish view of the same stock than self-described bears. So people are putting themselves, if they already are bullish about Tesla, they are looking for people to confirm this belief. And they are deliberately kind of not seeking out information that might contradict that belief. And this is also true for professional investors. This is twice as strong for the people who actually trade on that information, at least by self-declared trades. And it's stronger on news days, so days when information comes out, when you would expect, in fact, people to start agreeing more and to start for this effect to get weaker, but instead it gets stronger on days when information comes out. And if you look at people's news feed, which is just a flow of tweets and information that they see, we find that bulls see over 70 more bullish messages and 15 fewer bearish messages over the next 50 days than bears. So you see that by selecting into an echo chamber, you're selecting into essentially watching Fox News or selecting into watching MSNBC, something that will confirm your prior beliefs, which is similar but not the same thing as confirmation bias. So confirmation bias is when you see information, you interpret it in light of your priors. This is like you are choosing to watch Fox News, knowing that Fox News will give you more Republican information, or you are choosing to watch MSNBC, knowing that it will give you more information that's lined up with Democratic beliefs. And interestingly, we find that stock picks made in echo chambers actually do worse in terms of the stock returns. So this is, clearly a bad idea. If you want to make money on the stock market, then you really don't want to be doing this echo chamber type behavior. Over the next 10 days, you're going to lose about 1.4 percentage points lower return by being in an echo chamber. And this echo chamber behavior is strongly associated with more trading volume. So by being in an echo chamber, there is more disagreement among investors because bulls only talk to bulls, bears only talk to bears. And as a result, there is more disagreement. People are kind of polarized in their opinion about the stock. And whenever, as I mentioned before, whenever there's more disagreement in views among investors about a stock, there's more space for people to trade because some people think it's valuable, some people think it's trash. And so those people have an incentive, to sell the trash to the people who think it's valuable and vice versa. So I'm kind of out of time, Maybe I can show you a couple of pictures. You can see that people who declare themselves bulls on day 0 are much more likely to follow other bulls than people who declare themselves bears, and vice versa for bears. This is true also for the number of bullish messages or bearish messages that they see, the number of likes of bearish and bullish messages that they click on and say, I like this message. So it's not just a follow, it's an active reading of these messages. And when we look, is it just amateurs? No. More professional investors do this. The people who declare trades also do this. And on news days, this is also true. All of these things really are surprising based on our standard models of investors and our standard understanding of how investors operate. And so, I think I might be out of time, but essentially.
You're fine. You're fine. Keep going. This is great.
A couple more minutes. Okay. So I mentioned that people in echo chambers do poorly. So first of all, let me just kind of show you what this is. This is a regression table. So I know it looks a bit dense, but the first square that I want you to look at is this. So what this says is, the abnormal return on investments following a bullish declaration is actually minus 1.4 percentage points. So that means that people, that if you follow the StockTwits sentiment, you're going to do 1.4 percentage points worse than if you don't. So people are actively wrong on StockTwits. If you follow kind of the average view on StockTwits, you will be losing money on average. And secondly, that a third of this underperformance is attributed to, if you are less echo chambery, if the signals that you receive are more diverse, then that actually offsets this underperformance by about a third. So you would be about a third better off if you were not in an echo chamber. And you might think, well, is this all just novice investors who are just bad at this because they're just dumb money? Actually not. Even professional investors do better, but even though they do better, they are still in an echo chamber. They still lose money because of these echo chamber effects. And you can see that the return dynamics show this, that people who are bullish, they declare themselves bullish on day 0, and then the abnormal return on these picks is strongly negative, for days 1, 2, 3, 4, 5, 6, 7, 8, all the way until about day 10. But those who have higher, who are basically not in an echo chamber, when they make these declarations, do better. And so these two lines offset each other. So you should see, this is like plus 0.1, minus 0.5. So the net is minus 0.4. And you can see that basically being out of an echo chamber kind of pushes against these negative returns. Doesn't offset them completely, but it pushes against them. Okay. So in conclusion, I know I kind of ran through that, but this is just another way that we're using StockTwits as a laboratory to examine bullish and bearish sentiment, and to examine a specific feature, which is, do investors behave rationally, or instead do bullish investors and bearish investors cluster in echo chambers? And it's really quite surprising that they do, because they're choosing to receive information that confirms their views. And this actually costs them money. They have a financial incentive not to do this. They want to know if they're bullish about Tesla. They want to know any bad news about Tesla, to be able to update their position and to change their investments. But instead, people are saying, you know what, I don't want to hear it. I just want people who already agree with me. And that is costing them money, not just on StockTwits, that's costing them money, in the stock market itself. And this is surprising. It's costing money. It's the first evidence that we've seen of this. And we also show that it drives trading volume. I haven't shown you that because it's kind of involved to show, but trading volume on the market is also greater when there are more echo chamber behaviors on StockTwits. So again, we can see StockTwits as being a very effective laboratory of sentiment about the stock market that shows up in actual trading on the New York Stock Exchange or on NASDAQ. So thank you very much. So I went slightly over there, but this is what I wanted to share with you all.
Professor Mullins, thank you so much. I know that there are some attendees here who probably have questions. So if we have a little bit more of your time and we have questions, I would love to go through those. I didn't see them go in the chat, but I did see both Aaron and Alicia commenting on this confirmation bias. So I'm not sure if you caught that and then commented on it, or if it was just good timing on everyone's part.
So let me just check out the question. But confirmation bias. Yeah, so this echo chambers are very related to confirmation bias, but not quite the same thing. So confirmation bias, to caricature it, basically it's you give me some evidence and I'm going to interpret the evidence you give me based on what I already think about it. So let's say I'm a Democrat, you give me something that President Trump has just written and I'm going to be like biased against. Selective exposure that leads to echo chambers is actually slightly different. It's I avoid information that might disagree with me. And so it's a little bit different, a little bit more active, and could have perhaps larger scale consequences, because it's about what information even gets to cross my table, or gets in front of me, rather than how I deal with information once it's already in front of me. But it's a very good point. These are kind of closely related concepts. I think there was another question. So Timothy had a question.
Thank you. Can you hear me?
Yeah, perfect.
Okay, great. Very fascinating. I appreciate the topic. I did have a question about that kind of relates to both of your different papers.
Mm-hmm.
On the first paper, it seems like your statement is that the COVID-19 uncertainty drove this partisanship into StockTwits, which was unexpected.
Mm-hmm.
In my mind, it seems that the COVID-19 uncertainty might have been an uncertainty for one group, but not an uncertainty for another group. Meaning, at least in the United States, there was one political group that didn't really think that it was a real issue, whereas another political group did feel that it was a real issue. And so somebody might take a downsized stock and be very positive about the opportunity for it to turn good, because they were seemingly disconnected from that social reality. And so how that follows on to your second paper is you're saying that echo chamber is being in an echo chamber provides a worse performance, and a lot of things in life that's true. But my question to you is your second paper based on the same data set as your first paper? Because in this case, and the chart you're showing, it seems like if you're in one particular echo chamber, you did worse. But if you were in a different echo chamber, you probably were more in alignment with the reality of what the market was doing, and you may not have had such poor performance. Betting on a positive response when you were separated from the reality of the situation. So the question is, does your second paper rely on the same data as your first paper?
So that's a great question, and I like how you caught this idea of that echo chambers could be about bullishness and bearishness about a stock, which is what the second paper is about, or it could be a political echo chamber, which is do Republican people on StockTwits like to listen to other Republicans or not? And I'm certain that the two are related. But to kind of go more specifically to your point, they are somewhat different data sets. The political one is much more constrained than the echo chamber one, because we need people to make partisan comments to be identified as Republicans. And the interesting thing about it is actually, in this setting, that if you look at what I have on the screen here, this is a very much a zoomed in COVID picture. The people who were in the echo chamber, who were the Republicans, potentially, we don't prove that they're in an echo chamber because it's a slightly different question, but they were in an echo chamber because everybody else, both the stock market and everybody else, were getting very pessimistic. Republicans weren't, and actually they were the ones who did very well in terms of their investment returns. So the irony is here, being in an echo chamber was great for your investment returns. Whereas not being in the echo chamber, you just followed the market all the way down and then missed it when it came back up again. Or just moved with it rather than buying when it was at the bottom. So there is actually kind of quite a lot of nuance here. But they are somewhat different questions, because in one setting, we are showing that a kind of model, a political model, which essentially has no natural place in an investment decision, is showing up, which is the first paper. And in the second paper, a very natural thing to think about, which is, are you optimistic or pessimistic about the prospects for each of your investments? We find that people are irrationally consuming information. So instead of consuming all of the relevant information, they're essentially throwing away important pieces of their information, because presumably it imposes some kind of psychic cost. But then it's not at all political. It's about whether Tesla's going to do well, whether Walmart is going to do well. And so they're related but different. So I love how you connected the two, and I think that there are some very natural connections there.
So does this chart? I may have misunderstood this chart. This chart splits where the partisan Republicans were actually being more successful. Is that what the red line is saying, or is that their view of optimism was out of alignment with the market?
It's an optimism measure. So the difference between the black line and the red line is the measure of the disagreement between Republicans in red and everybody else in black. And the S&P 500 is this blue line, and you can see everybody else was basically following the stock market, was basically following the S&P 500.
Right, but does that optimism about stocks that is going down, does that actually indicate successful profit in the market? So
if you were to, if you ask me if I could go back in time, I would have done what the Republicans did. I was pessimistic. I thought things were bad. I was probably in the black line, but with hindsight, this was a great time to be optimistic. So you were buying when the prices were low, very low on the 23rd of March, which is the low. And if you had bought then and held it until later, you would have done extremely well. So we don't actually have people's direct investments, but what we can do is we can infer, how they would have done. And in this case, the Republicans were right, but they were right because they anticipated things that may or may not have been easily anticipated, like the fact that there was going to be very effective stimulus, the fact that we were going to find, very effective vaccines surprisingly quickly, things that happen later. But,
or that would all just go away.
Oh, they were all just go away. Exactly. Yes. That could have been the model that they were using, and they ended up being right for different reasons.
Yeah. Well, thank you very much.
Yeah, no problem. Were there any more questions?
Hi, Professor Mullins. That was very insightful. Thank you. I had a question. So from your first paper, there was some evidence that Republicans seem to show significant herding with the recent losers and the S&P 500. Mm-hmm. Did you notice that for that political party as opposed to the Democrats? Did the Democrats not really show that much herding at the time of March 2020 compared to the Republicans?
So I wish I could answer that question. We really tried to be able to identify enough Democrats to produce a chart like this, but there just weren't enough. So even though we had a few very vehement Democrats, we need kind of hundreds and hundreds of them to have small enough standard errors for us to be confident, small enough, basically uncertainty about the size of the effects for us to be confident in the result. And so we just didn't have enough Democrats. So the whole paper is focused on Republicans, not because Republicans, are special. They are, but equally special with Democrats. It's just that we just didn't have enough Democrats. Suggested evidence was that the Democrats were kind of the mirror image of the Republicans. But it was only suggestive, and so we had to kind of remove it from the paper and just compare Republicans to everybody else.
Got it. Thank you.
There might have been one more question, and if not, Julia, over to you.
Thank you. If anybody has any more questions, I would love to field them, but if not, we'll go ahead and wrap it up. I didn't see anything else in the chat.
Oh, yeah.
So a huge thank you to you, Professor Mullins. Thank you for holding this master class for us. Thank you to all those who have attended. I know that we had about 35 or so originally registered, but I did notice some duplicates in that. So this may have been the full grouping anyway, but thank you all for being here. Again, thank you, Professor Mullins. And for anybody who has questions, feel free to reach out to us. You've got all of our emails now. This recording of the masterclass section is definitely going to be posted to our channels. We have channels that you'll see, and we get those sent to you in regular emails as well. So again, have a wonderful evening or a wonderful day for those who woke up really early in India. Thank you for joining us. Have a wonderful rest of your time wherever you are, and join us again next week for a masterclass with Professor Amy Chung Nguyen, who teaches Lab to Market. She's going to be telling us about that next week. So thank you, everybody. Thank you, Professor Mullins. Thank you to our current students who joined us today, and as well as all of our staff. So thank you, thank you, thank you.
Thank you, everybody. It was great to be here.